G'day again. I just wanted to cover some more on this topic of whether our investment boom is over or not, but I really want to focus on the implications specifically for you and obviously taking advantage of opportunities that we have around us is excellent, but protecting your capital is also vital. So I want to focus on that issue in this video. So how can you do that? How can you protect your capital? Well, the first option, of course, is just to go completely defensive and stay in cash. Now, in my view, it's not a good idea because as real inflation ramps up, and real inflation is a lot higher than what the official CPI figures are, and it's going to continue to ramp up with all the money printing that we've got. So that's one option. I don't think it's a very good one at all. The second option is to go into the real defensive stocks. But the banks and the telecommunication stocks like Telstra have had a huge run over the last couple of months and really are already fully valued, or in some cases probably even a bit overvalued. So yes, you can get 6 or 7% dividends, but to my mind there is more downside risk to your capital than there is upside risk from the current levels, because when stocks have already had a significant appreciation, then the odds favour perhaps a bit more coming from the downside. So it's far better to be buying stocks when they're undervalued. And the third alternative is to look at something like government bonds. My view of bonds is that this is not a good risk-reward time to be buying bonds, because you're going to be locking in interest rates at the lower end of the scale, and you're exposed to a risk of capital loss if you have to cash it in early. And the lower risk nature of bonds mean that the returns may be inadequate for what you're looking for. The other alternative, of course, is just to buy great businesses, businesses that have proven that they're resilient through the worst of conditions. Let's have a look at a couple of businesses. One that is exposed to the mining boom, which is Monadelphous engineering, and the other one, which I think people would rarely consider as a good investment, and that's Dominos Pizza. It's probably just not on most people's radar. Monadelphous engineering, return on equity 70% to 95% typically over the last 5 to 10 years. They've been an amazing performer. If you bought the stock in 2006, you would have paid about $4.70. Since that time, you would have got all your money back in dividends if you'd sat through the GFC. And the current price is $22. So there's been a very, very significant capital gain there. So all up, 5-year average return, which is dividends plus capital gain, about 15.7% per year, and that's including the GFC. Now, Domino's Pizza, return on equity lower, but still good. There aren't that many places where you can go and put your money where you're going to get a 20 to 30% return on your money. The price has escalated by roughly 300% since 2006. A fair slice of your original purchase price has come back via dividends, and a very good 5-year average return thanks to the capital gain. So a couple of really, really strong performers. So let's have a look at those individually just a little bit. Monadelphous, was virtually no impact on their financial results from the GFC at all. They just really hardly missed a beat. Yes, the share price dipped and it went down to probably just above your entry if you bought in 2006, but it had regained most of that downside within 12 months and then just continued on. And it just shows that great businesses can still perform very well during fairly adverse periods. The other thing that it also demonstrates is how well or how good buying insulates you in the future. If you buy well in the start, then it's much easier to ride through some of the rocky bits. Let's have a look at Domino's Pizza. They've been an outstanding financial performer for a lengthy period of time. They've had consistent and relatively stable share price gains over the last 6 years or so, of the order of about 300%. Now, just a reminder, this is general advice only, so these examples are merely meant as that, just purely as examples. Now, great businesses are in the minority, but they are out there. Great businesses are often fully priced, or in some cases even overpriced. So you need an added element of knowing really when to buy, to know when the smart money is buying and can recognise value. So timing the market is a huge advantage, and you need to be able to read price charts, and you need to be able to follow global events to have a sense of the market. And basically that's what I do 24/7. Now, to gain access to my regular free information services, you can either subscribe to my channel, or you can visit our website at specialistshareeducation.com.au. Now look, I know there's a lot of uncertainty out there, and it's just so critical that you protect your family and your future by keeping your wealth building efforts on track. Despite all the negative sentiment in Australia, there are still wonderful investments available. I'm going to be sharing my research and strategies with you. There's plenty of free information and training on the site, so check in regularly and enhance your journey to personal wealth and freedom. Cheers.